So you're looking to save and invest. What type of account are you going to use? You have a 401k at work, your spouse has a 403b, but maybe you should be using an IRA. And should that be Roth or traditional? Or maybe just a taxable account? Stay tuned. Investing basics, types of accounts and their uses, coming up. It's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, go ahead and subscribe. And if you are viewing this from the blog page of my website, fill out the contact form at the top of the page so that we can contact you when new content becomes available. When it comes to investing, there's a lot to consider. And something that can be just as important as what you choose to invest in is the type of account in which you choose to hold the investments that you make. In this video, I'm going to go over some of the different types of accounts and retirement plans available. And if you stick around until the end, I'll also talk a little about what types of investments might be most appropriate for each. Listed are some of the accounts and retirement plan types allowed for by our tax code. And as you'll see, it's a lot. However, the fact that these accounts are created by the tax code, which they are, often the names they have, 401k, 403b, 457 plan, are simply a reference to the section of the tax code that allows for that type of account or plan's existence. That fact explains why choosing the correct account matters. It will likely affect how you will eventually be taxed. And what good is an investment gain if, at some point, you're going to have to turn a big chunk of it over to the government in taxes, especially if, to some degree, this could have been minimized by simply choosing a more efficient account or plan type. Furthermore, the fact that these accounts are often created by the tax code means understanding them isn't necessarily simple. Unfortunately, elegant simplicity never has been, and I doubt ever will be, a U.S. tax code strong suit. However, if the bad news is that there are a lot of plans and account types to understand, the good news is many accounts fall into a much fewer, broad set of categories of tax treatment. Many differ only in the type of business or employer that might be allowed to offer that type of plan, or in the contribution amounts that participants can make each year. But frequently, there are several different plans or accounts that will eventually be taxed in ways that are similar or identical. And it's for this reason that assets from one type of account can, under certain circumstances, be transferred to an account of a different name without issue or tax consequence. For example, from a 401k to an IRA. In some cases, transfers like these are allowed because, for tax purposes, the two accounts in question are basically identical. So, what are some of these broad categories? Well, I'm going to talk about three, which are traditional pre-tax tax-deferred accounts, non-qualified taxable accounts, and Roth accounts. Let's start with traditional pre-tax tax-deferred. Pre-tax tax-deferred accounts and retirement plans make up the largest family of accounts and hold the majority of Americans' retirement savings. These accounts include 401ks, pension plans or 401as, 403bs, 457 plans, traditional IRAs, as well as others. The way these accounts work is this. When the contribution is made, either by you directly or by your employer for your benefit, no income tax is paid on that money. Furthermore, as the money is invested and earns gains or investment returns, no taxes will be owed on those investment returns as long as the money continues to stay in that tax-deferred account or plan. However, at the point that this money is withdrawn or distributed, it will then be taxed as ordinary income to the recipient at that time. The advantage of this type of plan is that it gives you the opportunity to lower your current taxes by deferring some portion of your income into the tax-deferred retirement account. This means that you won't have to pay taxes on that income during the current year, but instead at some point in the future, presumably when you are retired. As an example, say I make $100,000 this year, but I contribute $15,000 to my 401k. That means I will only be taxed on $85,000 of earnings in the current year. The $15,000 that I contributed to my 401k won't be taxed until I take it out during my retirement. A couple of notes about these types of accounts. Typically, the money contributed cannot be withdrawn before the account holder has reached the age of 59 and a half without incurring a penalty. Usually, the penalty is 10% of the amount withdrawn. Of course, that money will also likely be fully taxable since the contributions were made pre-tax. No taxes have been paid on any of those dollars. This fact will be true regardless of your age. And lastly, once the account holder has reached the age of 70 and a half, he or she will be required to begin taking money out. This is called required minimum distributions, and it is basically the government's way of saying, we've been letting you defer your taxes on this money for a long time now, and we think enough is enough. The second type of account is a non-qualified taxable account. This simply means having an investment or brokerage account with a broker. Frequently on brokerage statements, these are referred to as individual accounts, or if you hold an account such as this jointly with, say, your spouse, a joint tenants account. On the surface, it would seem like this type of account offers no tax advantage. Since they are not dedicated accounts for the purpose of retirement savings, a goal for which the government is willing to give you a tax break in the other categories, they do not offer either current tax savings or tax deferral. However, the truth is a little more complicated than that. Many of the types of investments that people typically make, such as the buying and selling of stocks or bonds or earning qualified dividends, could result in what are referred to as long-term capital gains. For the specific tax treatment of your investments, you're going to want to speak with your financial advisor or tax professional. However, when this is true, the long-term capital gains tax is generally lower than the ordinary income tax that you would pay on your regular income, say the salary from your job. In 2019, the year I'm making this video, the highest ordinary income tax bracket is 37%. However, the highest capital gains rate for most investments is 20%, and the majority of taxpayers pay 15%. In the pre-tax tax deferred accounts mentioned earlier, your distributions will be taxed as ordinary income. In those types of accounts, what types of investments you made and therefore whether or not they would have qualified as capital gains is irrelevant. The other benefit of a non-qualified taxable account, there are no penalties for taking money out, regardless of your age. This is just a taxable investment account. It's not specifically dedicated for any particular purpose, and therefore the government doesn't apply any special rules or conditions. It's just an account that you might have to make investments. Lastly are Roth accounts. Originally, these were Roth individual retirement accounts or Roth IRAs. However, now many employers offer a Roth option in their 401k plans, and you might even see the same option in a 403b or a 457 plan. The way a Roth account works is, you get no current tax benefit on the dollars that you put into your Roth account. However, as long as you follow the rules, generally that you wait to take the money out until after age 59 and a half, and also that the Roth itself has been open for at least 5 years, you'll never pay taxes on that money again. So the money goes in after tax, but any investment returns or growth that happen in the Roth account will be money that comes to you tax-free. That's a good deal. So what type of account should you have, and what investment should you make in each? Well, as is the case in all things financial planning, that depends on your situation. However, knowing how each of these types of accounts work can help you align your goals and specific concerns with the account or retirement plan that is most appropriate. For instance, if your biggest concern is your current tax bill, then you will want to look at putting as much of your current income into a pre-tax account as you can. However, if you are worried about the amount of savings that you already have accumulating in pre-tax accounts and the tax bill that you are eventually going to face in the future, that might favor looking at a Roth or taxable account. One problem in determining a best strategy for which account will result in the best case scenario, it requires being a bit of a psychic. Since no one really knows what tax rates will look like in the future, there is no guaranteed to be the best answer as to whether you should defer your taxes, say in a pre-tax account, or get those taxes paid in a Roth account and then hopefully never pay on that money again. For that reason, something that might be a potential red flag in an investor's portfolio is to have all of your savings in just one type of account, say all in pre-tax or all in Roth. Similar to not having a portfolio that is diverse in the types of investments it holds, that would be failing to have a diversity in your tax exposure. So again, when determining which of your investments you are going to hold in each account, here you're going to want to make sure that the goal for that investment, as well as things like the investment's timeline, expected return, and what type of return it is going to be, for example, would it qualify for long-term capital gains, is in line with the advantages that the account that you are using for that investment offers. An example of a mismatch might be, I once had a prospective client show me his Roth IRA portfolio, and in it he had a number of certificates of deposit. For those of you unfamiliar, a certificate of deposit, often called a CD, is a cash deposit that will pay a fixed interest rate and has a fixed date of withdrawal or a maturity date. We think of a CD as a cash equivalent. There's certainly nothing wrong with having cash as a component to an investment portfolio. However, this would be an investment that is not going to produce a particularly large investment return. That would not be its purpose. Therefore, it would be hard to think of a reason why it would ever make sense to hold such an asset in a Roth account, which is to say an account that gives as its specific benefit no taxes on an investment's growth. That is a poor alignment of investment to account type. So in looking at your own portfolio, you're going to want to ensure that your investments are taking advantage of the specific benefits that the account that holds them offers. Growth investments are well suited for Roth accounts. If you are holding a certain amount of cash, possibly for an emergency fund, and you are under the age of 59 and a half, that should not go in a pre-tax, tax-deferred account. Doing so would mean, should you have an emergency and need that money, you'll likely be paying a 10% penalty to get those dollars out. However, if you are over that age, maybe even nearing 70 and a half, the point at which you are going to need to take your required minimum distributions, then having some amount of your tax-deferred dollars in cash or maybe some kind of fixed income investment might make a lot of sense. And if you're going to hold a portion of your investment portfolio in a taxable account, something that is frequently the case, it might make sense to have those assets be of the type that produce investment returns that could potentially qualify for long-term capital gains tax treatment. Managing an investment portfolio is a challenge. Ensuring that you are not simply making wise investment choices, but that you are also holding those investments in the most appropriate account might be another great reason to speak to your, hopefully, certified financial planner professional. I'm Jeff Drayton. Thanks for watching. As always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letter CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.